Not long ago, I talked with a couple who sold their house back in 2022. They were absolutely convinced the market was about to implode. So they moved into a rental, thinking they'd cleverly sidestepped a disaster. Their plan? To buy back a dream home for pennies on the dollar in a year or two. Well, here we are in August 2025. They're still renting. And that house they sold, they've watched its value climb, leaving them priced out. This isn't just a one off story, it's a cautionary tale. So many people are sitting on the sidelines, paralyzed by fear, waiting for a crash that all the real data says just isn't in the cards. So today, we're going to cut through the hysteria. We're going to take apart the doomsday predictions piece by piece and show you what's really going on. Because what if the people screaming bubble are dead wrong? What if this is absolutely nothing like 2008? The constant drumbeat of crash headlines creates a powerful and frankly destructive narrative. It's an echo chamber of anxiety cranked up to 11 by social media and clickbait headlines. But this narrative does more than just stress people out, it leads to huge financial missteps. It convinces good people to sell appreciating assets. It pushes would be buyers into renters, where they build zero equity while their rent checks keep getting bigger. This paralysis is the real crisis. People are putting their lives on hold, delaying moves, passing on jobs, second guessing starting a family, all based on a ghost story about the market. The fear feels real, but it's based on a past that has almost nothing to do with the present. The 2025 market isn't the 2008 market. It's not even in the same league. The first and biggest myth we have to bust is this lazy comparison to 2008. It's a go to argument for every armchair economist, but it completely falls apart the second you look at the facts. Let's be crystal clear, 2008 wasn't a normal downturn, it was a full blown financial meltdown sparked by systemic rot in the lending industry. So, first, look at who's getting loans. The lead up to 2008 was an era of fog and mirror lending. If you were breathing, you could get a mortgage. They had ninja loans, no income, no job, no assets. Seriously. Today, lending standards are rock solid. Post 2008 regulations changed the game entirely. And the average credit score for new mortgages has been near record highs. Then, second, look at the loans themselves. Back then, nearly 40% of the mortgages were adjustable rate mortgages, ARMs, many with ticking time bomb, teaser rates that were set to explode. Today, ARMs are just a tiny slice of the market. The vast majority of homeowners are locked into a stable, fixed rate mortgage, many with rates well below what you can get today. They aren't facing that kind of payment shock. And maybe the most important difference, equity. In 2008, people were treating their homes like ATMs, pulling out cash and leaving themselves with no skin in the game. When prices dipped, millions were instantly underwater, creating a massive incentive to just walk away. Today, it's the polar opposite. Homeowners are sitting on a mountain of home equity, over 11 trillion. Total mortgage debt is less than 43% of total home values. Even if prices were to fall, most homeowners would still have a huge equity cushion. The bottom line, the 2025 housing market is built on a foundation of well qualified buyers and staggering homeowner equity. The 2008 market was built on a house of cards. They are not the same. Next up is the myth that a recession automatically means a housing crash. People get this twisted because the 2008 recession was caused by housing. But history tells a very, very different story. If you were to look back at the last six major recessions in the United States, home prices actually went up in four of them. During the recessions of the early 80s, the early 90s, and 2001, home values held their ground or appreciated. The idea that a slowing economy is going to vaporize your home's value simply isn't backed up by the data. In fact, recessions usually do something interesting to mortgage rates. They make them fall to stimulate the economy. The Federal Reserve typically cuts interest rates. Cheaper money can actually give housing demand a bit of a boost, putting a floor under prices. So while headlines might scream about a recession, history shows it doesn't spell doom for the housing market. This brings us to the third myth, the simplistic idea that what goes up so fast must come crashing down. This argument completely ignores the most powerful force in economics, supply and demand. The price explosion we saw a few years ago wasn't just random speculation, it was driven by a historic mismatch. For over a decade after the 2008 crash, America chronologically underbuilt houses. At the same time, the largest generation in U.S. history, millennials, stormed into their prime home buying years. More buyers chasing fewer homes means prices go up. That's not a bubble, it's Economy 101. Now, things are changing. By mid 2025, inventory has loosened up significantly, with more homes for sale than we've seen in years. But we're still trying to dig out of a decade long hole of underbuilding. And while the lock in effect isn't as intense as it was in 2023, many homeowners are still hesitant to trade their 3% mortgage for a 6 or 7% one, which helps keep a lid on the total supply of existing homes. So, this fundamental imbalance is the structural support holding up the market. So, if we aren't crashing, what is happening? We're in the middle of a great normalization. After years of wild, unsustainable growth, the market is finally catching its breath and settling into a more balanced, healthier rhythm. This isn't a collapse, it's a cool down. Does this normalization feel like? For buyers, it's a huge relief. The days of waiving every inspection and getting into a 20-person bidding war are mostly gone. You have time to think, you can actually negotiate, price cuts are more common, and homes are sitting on the market a bit longer. This isn't a sign of a crash. It's a sign that buyers are getting some of their power back, which they haven't had for a very long time. Now, for sellers, it's about resetting expectations. You probably can't just throw your home on the market on a Friday and accept a pile of offers on Sunday. You have to price it realistically and be a little more patient. But the market isn't falling off of a cliff. Expert forecasts for 2025 and 2026 are mixed. Some predict a slight national price dip, while others see modest single digit growth. What they all agree on is a 2008 style collapse is not on the horizon. We're sitting on a while for a hot seller's market, but now it's going to be a more balanced and neutral one. If this data driven approach is helping you out, cutting through the noise, do yourself a favor and me a favor. Hit the subscribe button. We put out new videos weekly designed to give you the clarity you need to navigate this market and build your future. Okay, let's just recap the facts. Today's market has a rock solid foundation of high equity homeowners and strict lending standards, which looks nothing like 2008. History shows us that recessions don't automatically tank home prices. And finally, the market is supported by a fundamental supply and demand story that, while evolving, still prevents a price free fall. The doomsdayers have been calling for a crash every single year since 2012. Think about that. If you had listened to them, you would have missed out on a massive opportunity for building wealth. It's time to tune out the fear mongers and look at the real data. Instead of waiting for a crash that isn't coming, it's time to understand the market we're actually in. This great normalization is creating opportunities. It's a market that rewards patience and smart choices, not panic. Your focus shouldn't be on timing some mythical crash, but on making a clear headed decision for your future based on the reality of today.